Well, hi, and I wanted to follow up. So we've been doing um, some reviews on different ratios that I can actually be used for fundamental analysis, and we've already done the kind of like the quick ratio, the current ratio, and now I wanted to really cover the debt to equity ratio, which is really important because obviously it's really telling you how much debt you have to how much equity is already into the company. And the way to calculate it is, again, total debt divided by shareholders' equity. Um, Now, one of the things that I do like to, and again, when you actually derive it, you're going to use average debt from the beginning of let's say, the year to the end of the year. Or if you're looking at maybe a quarter, it's going to be from the beginning of the quarter to the end of the quarter. And the same thing on the equity side. It's going to be from the beginning to the end of that period that you're looking at, just to keep it very stable. And one of the adjustments that I'd like to make, because I mean, when you think about total debt, you usually just think about debt, what the company owes, especially when it comes to loans and so forth. But it can also include leases. So if a company is actually leasing a lot of their capital, or the facilities that they're using, and those leases actually have 5, 10, 15 years, then you want to be able to capture that as a form of debt. And and the way you do that is by actually looking at those lease payments over that time period and then basically discounting them back to a present value that you can then use as, okay, this is the debt for those leases and treating those leases as debt. And then you add that, into the total debt in the numerator so that when you do divide it by shareholders' equity, you're actually capturing really the true vet or the true debt that's actually owed by the company to not only its bondholders, to its banks, but also under its lease agreements. So you've got that total payout that it's going to be doing essentially in the form of a present value divided by the equity, and that gives you again a true ratio of the debt to equity. And it's really important because again, depending on the company, depending on the industry, especially very capital intensive industries, then their debt to equity ratio is probably going to be higher. Whereas when you look at technology companies, especially software companies, where they don't have a whole lot of capital, their debt to equity is going to be very low. And within the industries, obviously, you then have to look at those companies as far as what they are, how they are relative to one another. Because even though a company, let's say, in the industrials or in utilities, where they may have a high debt to equity ratio, maybe they're investing, in new capital, for the long term. And so in reality, yes, they may have a higher, debt to equity ratio, but over the long run, that debt which they've actually invested in new capital is actually going to give them gains or efficiencies where the peers or the other companies may not get the same efficiencies and gains, and so they'll actually end up being better providing better performance in the long run. And so you've got to take all of these things into account. And you've got to dive into it. You have to really understand, not only the type of debt, but where the debt's going into, and do that analysis. And most of that information is actually in the financial statement reports that they actually put out. You just have to dig a little deep into them, but it's very important. Again, this to me is a very important ratio, but you just don't use it on its own. This is one of those where you look at it, you do make comparisons, especially within the industry, across industries. But then you have to combine it with other ratios, which I will be covering in other sessions, to really truly get a good picture of what's going on within the operation and within the company itself. Not only on what it's doing for the benefits of its own stakeholders and its equity holders, but also how it looks relative to everybody else, all of its peers in the entire market, actually. All right. Thank you. And we'll move on to some other ratios in the next time.